All right, welcome. You know that feeling when you look at a company's financial report and it feels like you're trying to read a completely foreign language? Well, guess what? Today, we're basically handing you the Rosetta Stone. We're going to unpack how to read the story a company tells through its debt, and we'll be using a couple of really powerful financial ratios as our guide. So here's our game plan. First, we'll get a handle on what this thing called leverage even is. Then we'll figure out where all our info comes from. That's the balance sheet. After that, we'll dive deep into two key ratios, the debt ratio and the debt to equity ratio. And this next part is absolutely crucial. We'll see why analyzing these numbers is way more important than just calculating them before we wrap it all up with the big takeaway. Okay, so let's start at the very beginning. How do companies actually grow? Well, they have two main choices. They can use their own money or they can borrow money from someone else. And that choice, that decision to use other people's money to get bigger and expand, that is the whole idea behind financial leverage. Just think of leverage as a tool, like a lever for a business. It's all about using credit to enhance your capacity, to do more, to build more, and hopefully to earn a whole lot more than you could with just your own funds. It's really about amplifying your financial power. So where do we find the clues to figure all this out? Well, everything starts with the balance sheet. You should think of it like a treasure map for our financial detective work. It gives us a really precise layout of a company's entire financial landscape. Now, here's something that's super important to get. A balance sheet is a snapshot. It's like a photo taken on one specific day that says, here's what our finances look like right now. This is totally different from, say, an income statement, which is more like a video showing you what happened over a whole month or a whole year. The balance sheet just answers one question. What's the financial situation at this exact moment? And that financial photo is made up of three main parts. First, you've got assets. That's all the stuff the company owns that has value. Cash, buildings, equipment, you name it. Then you have liabilities. This is everything the company owes to other people. This is its debt. And finally, there's equity. That's simply what's left over for the owners once you subtract what's owed from what's owned. It's their slice of the pie. So these three parts are all held together by this one simple but incredibly powerful rule, the accounting equation. Assets will always equal liabilities plus equity. It has to balance, always. This simple truth is the foundation for everything we're about to do. It's kind of like the law of gravity for finance. All right, time for our first tool. This is the debt ratio. And I like to call this one the safety check because it gives you a really clear, almost instant read on a company's financial risk. You know, at its core, the debt ratio answers a really simple question. If you look at all the assets a company has, all its stuff, its buildings, its cash, everything, what percentage of all that was paid for with borrowed money instead of the owner's money? And the formula to figure this out, it could not be more straightforward. You just take the company's total liabilities and divide that by its total assets. That's literally all there is to it. So to get these numbers, we just peek at our balance sheet. See? The total assets and total liabilities are listed right there for us. So we'll take those total liabilities, about $2.9 million, and we're going to divide that by the total assets, which is about $12.8 million. Let's see what we got. And boom, the result is 22.71%. So what does that number actually tell us? It means that just about 23% of this company's assets are financed by debt. Or let me put it another way. For every single dollar of stuff the company owns, it owes about 23 cents to somebody else. Now, the real magic here happens when you track this number over time. If you see that ratio is falling, it means the company is relying less on debt, which is usually a sign that things are getting safer. If it's rising, well, the risk is probably going up. And if you ever see a company with a ratio over 100%, whoa, that is a massive red flag. It literally means the company owes more than it owns. But listen, this ratio isn't perfect. Its biggest weakness is that it can be a little too broad. I mean, it just lumps all the debt together, whether that debt is due tomorrow or 30 years from now. It also uses what's called the book value of assets, which might not be what the company could get if they had to sell everything in a hurry. So it's a fantastic starting point, for sure, but it's not the whole story. So let's grab our next tool, which builds on what we just learned. This is the debt to equity ratio. Now, if the debt ratio was our safety check, you can think of this one as our strategy gauge. It tells us less about immediate danger and a lot more about a company's long-term plan for growth. So this ratio is asking a slightly different question. It's asking, how much is this company relying on debt compared to the money the owners themselves have put in? It's really a measure of the company's appetite for risk, its financial aggressiveness. And this is exactly where you see that leverage is a true double-edged sword. Using debt can be amazing. It can supercharge growth and multiply profits for the owners. But if things go sideways, it can also magnify the losses in a really big way and put the entire company in jeopardy.
To calculate it, we go right back to our trusty balance sheet. But this time, instead of using assets, we're going to compare the total liabilities to the total equity. We're looking at the two main sources of funding for the company, what it owes versus what the owners actually have invested.
So we run the numbers and we get 29.38%. The meaning here is crystal clear. For every single dollar of capital that the owners have personally invested in this business, the company has gone out and borrowed about 29 cents. But here's the tricky part. With the debt ratio, lower is usually safer, right? But with debt to equity, there's no single good number. A high ratio might be seen as super aggressive for a stable, older company, but it could be totally normal for a fast-growing tech startup. What it means really depends on the industry, how old the company is, and what its overall strategy is. And that brings us to what I think is the most important part of this whole explainer. Look, we've calculated a couple of numbers now, but the numbers themselves, they aren't the answer. They're just the start of our investigation. Seeing them side by side like this makes the difference so clear, doesn't it? The debt ratio is our safety check. It answers, how safe is this company? The debt to equity ratio is our strategy gauge. It answers, how is this company planning to grow? They tell two different but deeply connected parts of the very same story. This all comes down to a really crucial idea, and it's captured perfectly in this quote. The skill is called ratio analysis, not ratio calculation. Think about that. I mean, anybody with a calculator can get the number. The real value, the real skill is in the analysis. It's about understanding what that number truly means in its full context. You know, it's a lot like being a doctor. First, you gather the symptoms. That's the raw data from the financial statements. Then you run the tests. That's us calculating the ratios. But the most critical step, the one that really matters, is making the diagnosis, analyzing those results within the bigger picture of the company, its industry, and the whole economy. So, let's wrap this all up. What's the big picture here? Well, today we've added two really powerful tools to our financial toolkit. And these tools help us peek under the hood of pretty much any company. Here's the final takeaway I want you to remember. Debt is never just a number on a page. It's a narrative. It tells a dynamic story of risk, of strategy, and of ambition. And by using these ratios, you're not just crunching numbers anymore. You're actually learning how to read that story. So the only real question left is, what story are you going to look for next?